Okay, so now let's go ahead and talk about internal structure in regards to liquidity and kind of build on the previous lesson of just understanding liquidity in general. And so we can then understand ultimately that range that's happening up here is happening basically in each one of these little swings in price as well as these highs. So in the pullback and then in the continuation, the pullback continuation. And when the trend reverses, that's happening up here as well as here, 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 here on lower time frames to facilitate those swings in price. Okay. And so for whatever reason, it's not really up to us to understand why, but the basic reasons why retail traders would be trying to enter in and put their stop losses is because they're trying to ride the trend higher, and or they have indicators telling them or strategies telling them that, okay, we need to put our stop loss back here for whatever reason or up here for whatever reason, even though, the trend is clearly going to, sooner than later reverse and come back down. They would have their stop loss in here because they probably, perhaps they have their stop loss here because they got in this area, or they have their stop loss here because they got in this area. And that's totally okay for them. But what is not okay is that they try to hold it and try to, hope and pray that the market's just going to go forever, which we know it doesn't. And we know that it is constantly seeking liquidity and it's constantly seeking supply and demand zones to be mitigated. And so now we're going to actually apply internal structure, which we've already kind of touched base on in previous lessons. And we're going to apply that to the liquidity concepts and see how that can work in our favor, as well as, how smart money uses that to fuel moves. So basically what we have is, as trend lines are building, regardless of the reason, regardless of, it really doesn't matter the reason. All we need to understand and agree upon is that under each of these little swing lows is stop losses in the market, and also known now as liquidity behind each of these little lows here in the market. And so for whatever reason, traders are putting their stop losses there. And then we have, basically a break of structure back here. At some point in time, price, likely broke a high from back here, causing or allowing us to understand that at some point price is going to return back down and likely mitigate the extreme demand zone in this leg here and push down to a discount so that we can look for a buy. And so when price does reverse and it takes out this here, causing a change of character and then the break of structure, we then understand that, okay, smart money is coming back to get all of these stop losses, and on the higher time frames, they're mitigating this demand zone. So they're using all of these stop losses under all these lows for liquidity, and they're coming down to close their sell to buy candles and simultaneously then opening buy orders here. And now at this point in time, these highs here have stop losses above them. And so these stop losses get run when we realign with pro trend, because retail traders then are saying, well, okay, we got stopped out here, so price must be getting ready to go this direction, and let's start trading with it that direction and holding it forever, hoping that, someday we'll go into profit. And I'm making fun of retail traders because I used to be one of them, and I used to trade that way and think, I'll just hold it forever, and I'll hold until, I'm way down here and then close it. But that just isn't what happens. It's just not how the market works, especially once you understand smart money and, smart money concepts. And so after the trend reverses in our demand zone, we can then see, okay, the same thing that happened right here is now happening right here, that all of these stop losses are getting run, and smart money is running right through them and adding buy orders, or, taking those stop losses to open more orders in the market. And that's why when price realigns pro trend, why it can just move without, ever retracing, without ever coming back into the market, or pulling back to give us an entry. If we are not a lot of the times getting in on this change of character or on this break of structure, a lot of the times this stuff right here doesn't even happen, and price just runs without us and moves. And that's how you catch moves that are extremely aggressive, because you know that, okay, there's so much stop losses now, and there's no selling pressure. There's really, or excuse me, there's no pressure going against us and against smart money, because they're going to run through all those stop losses and add more of their orders along the way. And so it's the same thing happening over here. These, as for whatever reason, as the trend runs down, there's going to be stop losses behind these highs. And then at a certain point, as we know, we would get, ideally we would get a break of structure back here. And at a certain point, we would get a change of character signaling that this pullback is going to happen. And when this pullback happens, it's just taking out all of these stop losses. And as retail traders jump in to chase this trend up, they then have stop losses here, and we get that change of character signaling that we're likely realigning with the higher time frame trend, and we're back now pro trend. And then smart money is just taking all these stop losses, and there would likely be a lot of liquidity below this low as well as above this high. And so that's why a lot of the times when you get that breakout or that pierce through there, it can trade substantially higher before pulling back, because there's no resistance left for these institutions, because they've taken everyone and they've gotten everyone into where they can target their stop losses. And so for us, those areas become technical levels. And so you can either target these demand zones that are forming in here if you're not sure. If you want to be more conservative, you can use the demand zones on each of these highs as targets for technical levels. Or if you're confident in your understanding and you're confident in your trade setup, you can then just target this high and hold a partial or whatever is according to your trade plan. But it can be, right at these highs, it could be your take profit levels or the demand or the supply zones that are created from them. And it would be the same thing over here, that, in this continuation, we would then be targeting these demand zones, demand zone, demand zone, demand zone, or the lows behind this, or just this swing low if you're confident in your trade setup. And so, yeah, that's pretty much it for the liquidity. I think in the next episode, or the next lesson, we'll put these on live charts just to show you. And we kind of already talked about this in the internal structure part of the market structure, but now I think with this understanding of stop losses and liquidity, it'll make a lot more sense. So we'll see you in the next video.